Hi, I'm Michael Yardney, and a lot of investors are asking, is this a good time to lock in your loans onto the great fixed interest rates that are available? You see, asking rates are the lowest they've been in decades, and currently competition amongst the banks are delivering some very attractive fixed rate loans. So how do you decide what's right for you? And what do you need to consider to ensure you're making an informed decision? Now, I personally don't think interest rates are likely to rise anytime soon. One reason I'm suggesting this is that in the past, despite getting the best advice I could from experts in the field, most of the times I've locked in on fixed rates, I've got it wrong. So maybe the fact that I was planning to lock in rates a few weeks ago was a sign that they're going to fall further. You know, it's a bit like every time I wash my car, it's going to rain. But more importantly, recently two bits of news suggested that rates won't rise anytime soon. Firstly, the Reserve Bank lowered its forecasts for the economic growth of Australia, and secondly, unemployment rose a bit. Both these factors are likely to keep rates low for a while yet. Of course, locking into your fixed rate, whether it's your home loan or your investment loan, gives you the advantage of knowing what your commitments will be for a predetermined period. This could be a suitable strategy if you want certainty for your cash flow commitments, especially with the likelihood that interest rates are eventually going to increase, and when they do, probably significantly. However, there are also some disadvantages that you need to be aware of before you make the decision. So with this in mind, I'd like to consider 7 questions you should ask yourself when you're considering whether you should fix your rates or not. The first question is, will I want to sell my property during the fixed rate period? If you would, there could be a penalty to break your loan commitment. The second question you should ask is, will I want to access the equity for my property, maybe to invest further during the fixed rate period? Often this comes at a cost that could be prohibitive. You should also ask yourself, do you need an offset account? You know, that's a transaction account linked to your loan. Many borrowers put their savings into the offset account, and the balance in that, the credit in that, offsets your outstanding loan balance so that overall you don't have to pay as much. Interestingly, most fixed rate loans don't have an offset facility. You should also ask, can I make extra repayments? Some lenders would restrict how much you could repay extra. So if you're going to save significant amounts, maybe you should leave a portion of your loan variable, or at best use an offset account. The next question you should ask is, what balance should you have of fixed or variable? Even if you've only got one loan, you still can have a split loan facility where a portion could be fixed and a portion could be variable, and that may give you the flexibility you need. Often beginning investors choose to lock in about 50% of their loans, while investors with larger portfolios tend to protect themselves by having a larger fixed percentage. Another question, of course, is how long should you fix your loan for? Now, that one's difficult because if you believe interest rates are going to increase in a year or two, and after that remain high for a number of years, then fixing in for a shorter period of maybe 1 or 2 years probably doesn't make sense. That's because your loan facility is going to mature and revert to the prevailing rates when they could be a few percentage points higher. Now, this is an area where you should take specialist advice. And the last question to ask yourself is, if interest rates are going to drop further, how much is it going to cost you if you lock in? Would that upset you if interest rates dropped further? I know I've been in that situation, but I took comfort in the fact that I wasn't trying to beat the banks. Instead, I just wanted to secure my cash flow position. But I know others became quite stressed when they locked in and suddenly rates dropped further. Now, I better give you a disclaimer. I'm clearly no expert in this field. As I've said, I've often fixed rates when it was the wrong time. So please get advice regarding your own circumstance from an expert. You see, there are lots of other issues you should consider, things like your job security. And speculating on rate movements is fraught with danger, and making a fixed versus variable decision for the wrong reasons could end up being costly for you. While fixing rates has got the benefit of achieving certainty with your mortgage repayments, breaking a fixed rate loan can be costly, and it could also, as I said, remove some of your flexibility. So choose wisely, because you're only going to know if you've made the right decision in 3 or 4 years' time. But remember, rates will rise one day, and as fixed rates tend to rise well ahead of variable rates, it's worthwhile keeping an eye on the leading indicators of what's happening to our economy so you can get in before the market turns. By the way, if you want to take advantage of the property markets, why not have a chat with the team at Metropole? Our independent, unbiased property specialist can sit down with you and help you formulate a property investment strategy if you're a beginner, or review your current portfolio, or review your strategy if you're already an experienced property investor. Why not get the team of Metropole on your side and be part of your wealth creation journey?